Hey guys, welcome to part 2 in analyzing transactions. We're going to look at a few more examples here to kind of break them down and help you understand how we as accountants analyze transactions in preparation to helping you understand debits and credits and how we journalize in another section. So let's get started here with example number 3. If this is the first video you've watched, examples 1 and 2 were in a previous video, so make sure you go back and check that one out. But here we go. Example 3, Walnut Creek Inc. borrows $10,000 from a bank, which is deposited into their bank account. The bank requires Walnut Creek Inc. to sign a formal agreement for repayment of the $10,000. So what happens here? Is there an exchange? Well, obviously there is some type of exchange, right? We're exchanging a promise. Now I know I said promises are not transactions, but there's there is an actual exchange here, but we're exchanging a promise that we will pay back for cash. And there's literally a transfer of cash from the bank to us. So something did exchange. That's why this is a transaction. So when we say promise, we mean that there is no exchange at all. There has to be an exchange. Well, there is an exchange. So we are promising to pay this money back. They are giving us $10,000 to borrow. So $10,000 in cash. So what happened? Well, we exchanged a promise to pay. We called this a note because we had to sign a formal agreement. And when we sign a formal agreement, we call that a note because it's a note that we signed that we would pay them back. So we exchange a promise to pay or a note for cash. Now, what accounts are affected? Well, we know that we received cash, therefore cash is affected. And then what also is affected? Well, notes payable is affected as well. What is a notes payable? So notes payable has two words in it. Note meaning the document that we sign, and payable meaning that we have to pay it back. So notes payable means we signed a note that we have to pay back. And a lot of students get confused here, but the word pay literally means what it means. I, the company, have to pay it, which also means that that is a liability. Okay, so what categories or components are affected? Asset is affected because cash is an asset, and liabilities is affected because the notes payable is a liability. So cash is an asset, notes payable is a liability. That's what affected. And then how are these categories affected? Well, cash, is it going to increase or decrease? It's going to increase, right? We're receiving $10,000, so cash is going to increase. What about the notes payable? This one's a little tricky, okay? But we're increasing the amount of debt that we have. Therefore, we have more debt, so the liability is going to increase. How do we decrease it? By paying it back. So asset is going to increase by $10,000. Liability is also going to increase by $10,000. What you'll notice here is that just because one goes up doesn't mean the other one goes down. Just because one goes down doesn't mean the other one goes up. So just know that we can have it up or down, or up and up, or down and down, okay? So asset increases by 10,000, liability increases by 10,000. Let's see how this affects our accounting equation. So we know that the asset cash is going to increase by $10,000. So we're going to put $10,000 on the asset side, cash increasing $10,000. That also means on the other side of the house, we have to have a positive because we have to equal out the same. So we have to have a positive, and it's a liability that we're affecting here in that fourth step. And that liability is called notes payable that we've identified in step number 2. So we're going to increase the notes payable by $10,000. Does this equation make sense? Well, 0 plus 0 plus 10,000 equals 10,000 plus 0 plus 0. We're good. Our accounting equation makes sense. So that is our example 3. Let's go ahead and move on to example 4 here. Walnut Creek Inc. purchased $11,850 worth of furniture, fixtures, and equipment related to their offices. They received their gear as promised by their vendor, so they've actually received it, so there was an exchange. Walnut Creek promises to pay within their credit terms with their vendor. So this is another example where we're going to get something in this exchange now, but we're going to promise to pay them later. Now, this promise to pay is a little bit different because notice it didn't say any note. So we're going to call it a different name here when we get to step number 2. So what happened? Well, we exchanged a promise to pay for equipment, furniture, fixture, and equipment, FFEs, okay? So when we talk about a promise to pay and there is no note, we call that an accounts payable. So an accounts payable, it's kind of like you have an account with the vendor. Just like if you're not 21, you don't know this, okay? If you are 21, you go to a bar and you open up a tab. What does that mean? When you open up a tab, that means that the bartender will continue serving you alcohol, and at the end of the night, they're going to swipe your card once for all of the alcohol that you bought. Now, typically to do that, you got to give up your card when they open up a tab. So what you're doing is you're opening up a tab, they have your card, and then as they make your drinks and give it to you, they'll take the receipt and put it in that jar. And at the end of the night, they add up all your receipts and then charge your account once. That's an account, okay? If you're not 21, disregard all of that because it's illegal for you to drink if you are in the United States. All right, so that's called an account. So when we get this equipment and we pay them, or we are going to pay them in the future, we call that an accounts payable because they have an account on us and they're keeping track of how much we spend, and then at the end of the month, they'll send us one bill. All right, what accounts are affected? So now that you know that we have this word called accounts payable, cash is not affected, but accounts payable is affected. So we basically exchange an accounts payable for the furniture, fixtures, and equipment. So the equipment is going to increase and the accounts payable is going to increase as well. Just like the liability in the last example, we're increasing the liability that we have with this other company, this other vendor. What categories are affected? So equipment, we know that equipment, does it provide, is it an asset, liability, owner's equity, revenue, dividend, or expense? Well, it's an asset, so an equipment is an asset. What about our accounts payable? A liability. So we have equipment, which is an asset. Accounts payable is a liability. And what categories are affected? Well, what categories are affected, or how these categories are affected, is that the asset is going to increase because we're receiving equipment, but then our debt is also going to increase as well. So our liability has to increase as well because now we owe more money. So asset is going to increase by $11,850. The liability is going to increase by $11,850 as well. So if we look at our expanded accounting equation, we get something that looks like this. So our equipment will increase by $11,850, and then our accounts payable will increase by $11,850 due to our step number 4. So equipment goes up by $11,850 and accounts payable goes up by $11,850. Does the expanded equation look make sense? So 0 plus 0 plus $11,850, $11,850 plus 0 plus 0. We're good there. So that expanded equation all ties out. Now, before we get going, let's again review this accounts payable and notes payable because it's super important. You're going to be using this all throughout the course. And accounts payable are typically informal credit issued by a vendor for which payment is due within a short period of time. It's informal because we're not signing a note every time they're delivering. Yes, we are going to sign a delivery slip, but that just says that they delivered the product. That doesn't necessarily establish debt per se. The invoice actually establishes the debt that we owe. So when we borrow money, aka we're not really paying for the equipment when we get it, we have an account. Now, notes payable are what we call formal credit because a note, a loan promissory note, is signed. That's a formal agreement, which is usually issued by the lender, whether it's a vendor or bank, which is solidified by a signed document. So that signed document is the note that creates the formalities of the debt. So we call that a signed document, a promissory note, or a loan agreement, typically for a longer period of time. It usually has interest attached to it. Accounts payable does not have interest attached to it. It's just an open credit. You just pay what you bought within that 30-day period. Now there's interest attached after it, but most companies will pay it within that credit period, okay? And then there's usually a payment schedule with a note. So whether it's you're going to pay it over time or you're going to pay one lump sum, but the interest over time, whatever that agreement is, there is usually a payment schedule with a formal note. So that's the difference between accounts payable and notes payable. Make sure you burn that into your brain because we have also accounts receivable, and that's going to muddle up these two terms. So the key word here is pay. You have to pay because the word pay is in payable. That means you are paying. Therefore, these two accounts are considered liabilities and not assets. All right, moving into example 5 here. Walnut Creek pays half of the $11,850 owed to their equipment vendor for example number 4. So we take half of this and we'll get $5,925. So that's how much we're going to pay. So this is basically what happens is they deliver the equipment and then we pay them back. In this case, we're told that we're only paying half of it. I don't know why we're not paying all of it, but there may be a good reason. We're paying half of it back to them. So what happened? We are going to pay them cash of $5,925. In exchange, what are we getting? We're really not getting anything other than we're getting a release in the liability that we've owed to them. So we're really getting a release of the accounts payable. So they're releasing us from the amount that we owed them. So that's the exchange at the end of the day. We're giving up cash. They are releasing us from owing them in the future on that debt. So that's what's happening. Exchange of cash for a release of the promise to pay or the accounts payable. Now, what accounts are affected? Well, we kind of already discussed that here in step 1. Cash is affected. That's going to decrease because we got to take the cash out of our pocket to pay our vendor. And our accounts payable is also going to decrease because we no longer owe them, right? So we want to remove that amount from how much we said we would owe them. So what categories? Well, cash, is it an asset, liabilities, owner's equity, expense, dividend, or revenue? It is an asset. So the asset's going to go down. And then the accounts payable, that is a liability. So we know that the cash is an asset, accounts payable is a liability, and therefore is the asset going to go up or down? Well, cash comes out of our pocket, meaning that cash goes down in our pocket, so the asset's going to go down. And what about the accounts payable? That's also going to go down as well. So that's going to decrease. It says increase, it should be decrease. It happens. Liability is going to decrease by $5,925, and assets also going to decrease by $5,925. So if we look at our accounting equation here, cash is going to go down by $5,925, and then our liabilities is going to go down by $5,925 based on our steps 3 and 4. So does this equation make sense? Well, 0 plus 0 plus a negative $5,925 equals a negative $5,925 plus 0 plus 0. Does that make sense? It does. Our equation does balance, so the transaction is done correctly. So that is all of the examples here in part number 2. We have one more part where we're going to go through even more examples. But again, the reason why we're spending so much time on this is we really want you to understand how a transaction is put together. and how a journal entry is done. Well, this is the first step to learning journal entries, is how do we analyze these transactions? If we analyze the transactions and we know we can come up with the account, and we know we can come out with its component, and then we know if it increases or decreases, it's going to make us do journal entries much easier. It's going to make you be able to do journal entries easier when we get to that section. So hope you enjoyed us walking through this example. And we will see you in the next lesson. We'll do a couple more examples associated with analyzing transactions. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.